Okay, this video is going to focus on price and specifically pricing methods. So this follows on from the introductory video to marketing strategies, which was looking at market segmentation. And then following that was product. And this is the second of the 4 Ps, but really the second of the 7 Ps now that we've got additional 3 Ps under marketing strategies. So price is clearly one of the most important elements to an overall marketing strategy. But the first important thing to understand is that there are pricing methods and there are pricing strategies. So the main pricing methods are a cost-based price, a market-based price, or a competition-based price. And then there are 4 key marketing strategies, being price skimming, penetration pricing, loss leader, and price points. Okay, in terms of price, it refers to the amount of money a customer is prepared to offer in exchange for a product, clearly. A price set too high could mean lost sales unless superior benefits are offered. So that one of the main reasons why it's so important is that if you set the incorrect price, if you set the price too high initially, you might turn customers off. If you set the price too low and you're having a negative impact on the profitability of the business, and it can be very hard to raise the price of a product once it's set too low. So it's crucial, really, from a marketing perspective, that price is established at the correct level early on in the piece. Additionally, in the context of a low price, as it says there, it might give the impression that the item is cheap and it's nasty and it's low on quality. Businesses must try to differentiate themselves in a market to then have more control over price, so they could effectively change the price without too much backlash from their customers. So in terms of methods, a starting point for what a business should charge are looking at, for example, their overall marketing objectives. What are the objectives? Is it increased market share? Is it profitability, for example? Their cost of production. Clearly, the cost of making that product must be factored into the price, because if it's a low-cost item to produce, it should really be a low-cost item to sell, and vice versa. High-cost item to produce, the business needs to recoup its cost, so therefore from a pricing perspective, it's going to have to set a relatively high price. Other factors to consider would be, what are your competitors doing? What are the government regulations in regards to price? What's the stage in the product life cycle? So if it's at the introduction phase versus maturity, for example, that's going to more than likely require a different pricing method and also a different pricing strategy. And also, what is the state of the economy? Can your customers actually afford the price that you're considering charging? Either, particularly if you're looking at the higher end of the pricing point, at the price point. These following methods help provide a basic price. So firstly, cost-based method. Cost-based pricing is a pricing method derived from the cost of producing or purchasing a product and then adding a markup. So before you get to strategies and you think about how you're actually going to strategically price your product, you need to think about what method is going to be relevant. If it's cost-based, that's basically saying, okay, it's cost us $1 to make, we want to at a 10% markup, so we're going to charge $1.10 for this particular product. And it just adds a standard margin or percent on top. Cost plus, and that's the formula there. However, it doesn't take into account that particular method, the level of demand and the value of the product to the customer or other competitors. It's simply about recouping costs and adding a margin on top. So without really considering those external factors. And that's really what pricing strategies do. They do take into account those additional external factors. So the value of the product to the consumer, for example. Another pricing method is your market-based. So looking at a method of setting prices according to the interaction between the levels of supply and demand. So whatever the market is prepared to pay. So for those of you who do economics, it's effectively the equilibrium price that the free market establishes in relation to that product. So in the context of that, supply, the quantity of a product businesses are willing to offer for sale at a particular price, and demand is what level of quantity the customer is demanding of that or willing to purchase at a particular price. In terms of competition-based, determining the price based on the price of your competitors. For example, Jetstar prices of flights in response to Virgin Blue cheaper flights. And you've got 3 options in relation to competition-based. Offer below your competitors, so undercut them. Offer prices equal to your competitors, so be following the price leader in your industry or market. or set it above your competitors, the perception that your product is a superior product. Okay, I'm going to leave it there, and in the next video we'll look at pricing strategies.